We are live, ladies and gentlemen. You once again, welcome to the Kingdoms podcast. And today I have with me fighting out of our line, Australia by way of Oxford, United Kingdom. Make welcome the undefeated Darryl Bates-Brownsword. How are you, Darryl?
Well, I'm not sure I can live up to that hype, but that's a knockout introduction, isn't it? But we'll give it a go and see what happens. Thanks for the intro, Adamola, and this will be good.
Your name is a weapon, so you should live up to the name at least.
It's a
Okay.
name, but yeah, it is what it is.
It is what it is, man. So, aside from the fact that your name is a weapon, you are also a weapon to businesses,
Well, we like to help them get what they're aiming for, that's for sure. And especially when it comes to the time where business owners are getting to the stage where they're thinking about their next chapter, we want to get involved and help make sure that goes to plan or goes to their desire by helping them put a plan in place. Because the reality is if you've been running and owning an entrepreneurial or owner-managed business for 5, 10, 20 years and you've built some value in it, you want to exit it and you want to make sure that you get the most from that value and get the most from the work and energy you've put into it. And only 1 in 5 actually get to do that successfully. So we do our best to see if we can influence that stat.
But you have helped a lot of founders to build, scale, and of course exit, right? And of course that has been across continents. But what was your first entrepreneurial spark?
I didn't have one. I wouldn't consider myself an entrepreneur at all. Grew up. My father was a career soldier, and so therefore worked for the government his whole life. So therefore, very conservative upbringing. My first job, I worked for a business owner and in a bike shop, and I saw how hard he worked, and I thought, "There's no way I want to do that. That's way too hard." So I ended up doing mechanical engineering at uni, worked for the government and as an employee, but got bored with how slow things were and wasn't real good at the details. So after 10 years, I went and joined a management consulting organization, again as an employee. I worked with them for a while and just, again, it just seemed all very going through the motions, if you like. And I did my MBA and focused on marketing and said, look, we can be targeting SMEs. A lot of the work that we do, we take for granted, but it's really useful and valuable information to SME business owners. We should be focusing on them. They said to me, you don't know what you're talking about. They can't afford it. That'll never work. Being young and dumb and in my 30s, I thought, well, I don't want to die wondering. Let's have a crack. I'll give myself a year, and if it doesn't work out, I'll go get a real job again. So I kind of fell into it. That was that's in 2000, 25 years ago.
Just on a lighter note, you said your father was a soldier, and I guess that name that is weaponized, just fits in properly.
Look, rumor has it, family rumor and an urban myth is that the name goes back to the Battle of Hastings. So any aristocracy that may have been part of the name is long gone. So
but of course, you still have the genes passed on.
I don't know.
And of course, you are a soldier at heart, and you're a mechanical engineer. That's quite an interesting background. I love engineers a lot because engineers always have the mentality and the methodology of offering practical solutions to real life problems.
Yeah, we're problem solvers, that's for sure, and very logical and sequential. Yeah, I guess the downside is we like to understand how things work, and
Exactly.
we like to piece the puzzle together.
Mm-hmm.
So I do that with businesses in how they're designed and how they're structured, and build logical structures and understand and model things, how businesses scale and what are the next problems that are going to be coming up for business owners and go, well, look, let's get on the front foot and solve this problem before it really starts to hurt. And that's always been an approach, and always having a methodology to solve each of the problems that we know are coming up.
Because, engineers are process oriented and they are always methodological in terms of their approach, and they have this advantage of the empirical, or would I say, the empirical method, basically, in terms of the approach to solving problems. And it helps them to strip things down and build things up. So that being said, how do you think that has actually influenced your leadership style? And
my leadership style, I'm probably a rubbish leader if you ask the people around me. But look, I am empirical. You're right. I look for patterns, and I see patterns in behaviors and processes and workflows, and help people to structure their business around those patterns. And when the patterns aren't followed, you tend to see mistakes. So I've got to stick with the strengths. As an engineer, you're probably not the best communicator, and a little quiet around those things. I don't know, but I can't. I haven't got anything at the tip of my tongue that says here's how my engineering strengths and my problem solving and has translated into a better leader. But I know I'm fairly visionary, and I help paint the picture for where we need to go, or where the client needs to go. I help them understand the picture, and using questions and guidance and prompting rather than telling to help them come up and inspire them to of what's possible and arrive at their own conclusions. And I think that's, if you just try and tell someone, here's the answer, they don't have any ownership of it. But if you help them find the answer, and through your experience and guidance and methodologies and frameworks you're using, then they'll arrive at the solution, the plan that they own, and they'll be more inspired and motivated to want to implement it.
Interesting. So in terms of that educational background that you have in engineering, how has that translated in the way you approach internal controls within businesses, and of course providing solutions to deficiencies in the internal controls that exists in the SMEs that you consult for?
So in terms of internal controls, my translation to that is I was exposed to internal audit and process control and governance in the corporate space. What I know in most SMEs is they often don't have that. They overlook it. Decisions are made from memory and a lot of the controls.
Instinct.
Yeah, and by instincts. And a lot of the controls and processes reside in the owner's heads. Which, when it comes to value, business valuation is just not transferable. So what we do is, one of the roles we play is we go, well, what we need to do if you want to exit your business, and if you want to maximize the valuation of your business, we need to unpack your head. All the stuff that you go is just intuitive and instinctive. It's not. You're following a process subconsciously. You're asking yourself a whole lot of questions. Yes, no, yes, no, yes, no. And we need to document that process that you're following. So we need to slow down the process next time it happens so that we can start to document it and capture a workflow. So we want to know how decisions are made in your business. What makes your business special? Well, just the culture, which is decision-making is part of culture, is a big part of that. So let's capture that. Let's capture the structure of your business. Let's capture how people know what decisions they can make and which decisions they need to refer to a higher authority or up the tree, and what's the framework each person has to make decisions in their role in the business. Once we start to document that, we start to have a framework. And I'm not even talking about just workflow processes yet. This is just decision making. When it comes to systemizing the business, we need a lot of that. We need to systemize the workflows so that there's no rework, and so that everyone's doing it the same way. And that way it'll be consistent, repeatable, and reliable. And then we want to apply that same methodology, that thinking process, to the way the business is run, i.e. how the business plans are set and budgets are set every year, and how do we keep the leadership team accountable to achieving those budgets so that it's not just a fluke. So, I guess I'm very structured in the way I do things, but The way you apply structure to a small business is you don't need reams and reams of paper and tight controls like you would have in a corporate. What we want to do is go, look, what's the right level of structure for this business at this stage of development so that it's going to be a help rather than a burden? Because if it's a burden to the business, it'll just slow it down, and people won't want to be involved, and they won't follow the process or the structure.
That's actually very, very correct. Only 10 to 40% of businesses that go to the markets actually are able to sell.
One in five, 20% will get a successful exit. And no, let me update that. 20% will agree a deal, so they'll get an exit. How successful it is up for debate. But most of those that actually get an exit have to agree some sort of terms of earnout and work through an earnout arrangement. And those often fail. So I'd say it's more likely 10% get a successful exit. 20%
so you're on the lower end of the range.
Yeah. So
Interesting.
you've got to prepare. You've got to set your business up. And I don't want to, I don't think you can overstate this. You really need to prepare your business and set it up specifically more than just, running good operations if you want to get a successful exit. And the key to that is if you're a business owner and listening to this today, and you're thinking, I want to sell my business one day, well, then my encouragement to you is right from today, instead of thinking about profit growth, like everyone is giving you advice and accountants, and maybe this is advice that you've given in the past, but instead of thinking, profit growth and every year on year we need to increase our profit, I want to encourage people to start looking at the valuation of your business. Get some work and go, okay, so what's the valuation of my business? And let me start thinking of my business year on year valuation growth, because there's so much more to increasing the valuation than just the profit. The profit are just the items that appear on the financial statements and the balance sheet. But the things that increase the valuation are your intangible assets. How much does your culture influence valuation? Your staff turnover, your staff retention, your client retention, your pricing model, your education, your systems, your IP, your brand. How much do those things influence your valuation? And you don't see any of those on any of your financial statements. So that's why I'm saying, think about the valuation of your business year on year, and you'll be halfway along to setting yourself up to getting exit ready or getting exitable. And if you make that mindset shift, you've got half a chance. You got to do better than half.
So what exactly actually makes businesses attractive to buyers?
Well, buyers, when a buyer looks at your business, right, they're going, hey, look, I want to buy this asset from you. So if you're going to buy a house, you would assess the risk to your capital on that house. You go, is it in a good street? Is it going to flood? Is it going to be subject to landslides, cyclones, or what have you? Where is it on the street? Is it the best house on the street? Is it the worst house on the street? Worst house, great, I've got some potential. What's the neighborhood like? Is it close to schools? Is it close to shops? What's the public transport connections like? You're assessing all of these things when you're going to buy a house. And you're going, okay, that's good, that's bad, that's got great potential, I'd pay more for that, I'm going to pay less for that. It's the same when you buy a business. Buyers are looking at your business and they're going, what are the risk factors? They're going, this business has grown by, 20% for the last 5 years. What are the chances that that's going to keep growing at 20% when the ownership changes? So if the ownership, if the business is highly dependent on the owners of the business, the key shareholders, in generating that 20% growth year on year, and then they want to leave the business, then that's hugely risky. Like there's a really low chance that number is going to continue under new ownership. So I'm not going to pay a lot for that business. If the owners can demonstrate to me that, well, look, all of our business comes to us because of the brand of the business. It's got nothing to do with me. I'm just steering it. I'm not the chief salesperson. I'm not involved in delivery. The business runs pretty well without me. I've got the management team. You have a look, they're running it. I'm just acting as a mentor and a guide. They put all the plans in place. They implement the strategies. They do all the sales. They do all the delivery. They do all the recruitment. They find new deals. They're doing all the work themselves. This business basically runs without me. Then from a purchase, acquiring the business perspective, that's hugely attractive. If it's had all that growth and all that growth happens without the owner's involvement, and you've got reliable cash flow and the future revenue is pretty well locked in, all these things start to reduce the risk of that cash flow changing or that cash flow growth or that finance trend changing. And the lower the risk, the higher the valuation. So things to look out. Do you have high staff turnover? Do you have low staff turnover? There's a risk. It's do you have to make separate sales every time you sell something, or do you have people on subscription? Two extremes there. What's your revenue look like? Do you have IP that people have to come to you because you're the only access point for the IP? Or are people coming because certain people work there, and are they coming to the person or they're coming for the product? All these things influence the valuation.
Interesting. So while you're speaking about these things, being an accountant myself, a chartered accountant that has been in public practice and also worked with two of the global Big Four firms, what comes to my mind is the accounting standard on business combinations, which is IFRS 3. So that actually speaks to the process of business combinations, and mergers, acquisitions are forms of business combinations. And of course, the sellout you talking about here relates to acquisitions. And then there's this other standard, IFRS 10, which is consolidation, right? So you acquire the business. IFRS 3 is the reporting standard that relates to that. But IFRS 10, now covers the point of consolidating that business that you've acquired, because you've bought the equity in that business, and it's now a part of the group, right? It is now a subsidiary to the parent entity that is buying it. So when you're accounting for the new company or the company that has actually been bought, right? So you need to compute the net assets, right? And then you compare the net assets to the purchase consideration. So the purchase consideration is what you're paying for that company. So there are usually two scenarios. It's either the purchase consideration is higher than the net assets, right? So if it's higher than the net assets, it means that you're actually paying a premium for that business that you're buying, and that relates to the intangible assets.
No, you're not.
And that premium is actually referred to as goodwill.
Yeah, but it's not a premium, is it?
It's pretty much a premium, right?
It's a premium from an accounting perspective, and you said you wanted a conversation. So it's a premium from an accounting perspective.
Yes, from an accounting perspective, right?
But
And
that's not the valuation.
When you actually pay less than the value of the net assets of that company that you're acquiring, which is called the is it the acquiree? Yeah, the acquiree, right? Because the acquirer is the buyer, the acquiree is, the company that has been sold. It's called a gain on bargain purchase.
Yeah.
Because you're purchasing that business at a bargain. So from you looking at things from the lens of the business seller, right?
I'm looking through a commercial lens.
But I'm looking at things from the lens of the business buyer. I'm the parent company.
You're also looking at it from an accounting perspective, which I'm going to argue is irrelevant.
Why?
So let's just take it to the most basic level, okay, of value. Who determines value? The buyer or the seller? You're going to go buy a new pair of jeans, right? The buyer, absolutely. You're going to go buy a new pair of jeans. There's a branded pair with designer label jeans for £200, $200, whatever it is. And you can get another pair of jeans possibly made in the same factory with no designer label on them. So very similar from a functional perspective for £10 or $10 that you can get in Asda or Walmart or wherever you are. Two almost identical items, different brand. So the cost to produce them, possibly similar. Now there's marketing costs, a whole lot of marketing costs to one that's increased. I won't say inflated, but increased the cost. So, and they sell them for a higher price. Now you might, one person might come along and go, look, why would I pay $200 for a pair of jeans where I can pay 10? That's just no value at all. That's a rip off. Someone else will go $200 for this pair of jeans. That's fantastic value. So as you say, it's the buyer that determines value.
I did not say the buyer, I said the market, because remember my first degree is in economics,
But what happens in a strategic sale?
The price of any item, when you look at it from a holistic perspective, is actually determined by the market forces of demand and supply.
The price is the price. The buyer determines if it's value and they'll pay for it.
But then you're looking at
the
it
market just tells us the average.
Yeah, the market tells us the average, right? And remember, it's not all the time that you just have a single bidder. Sometimes you have multiple bids for the same company, and you're probably selling to the highest bidder.
Well, depending on what we're selling, but yeah, and it depends on how much competition there is.
Exactly.
But yeah, so I'm not coming from an accounting perspective at all. I'm just coming as someone who runs business and looks at business and go, look, everyone else, all of your competitors are selling, I don't know, let's say you're selling a service and they're selling for $200 an hour. There's always someone out here who's selling for $1,000 an hour. And we can go, well, the market's $200. Well, how is this guy doing it for $1,000? That shouldn't be possible in the market because the market rate is $200. Well, that's what niching is, and that's what the intangible assets are. And that's a good example of brand value and positioning in the market and sales skills. And now, if you've got a rubbish product and you're selling £1,000 an hour, then you're going to get found out and you won't get many resales and you lose your reputation. But if you deliver a really good product and you're charging $1,000 an hour, the market will come to the point, well, it's expensive, but worth it. A bit like, was it L'Oreal, the shampoo? They will go, there's always room in the market for a whole range and a whole spectrum. And you don't want to be in the middle because in the middle you get lost and you disappear. And at either ends of the spectrum, you stand out and you can differentiate yourself. To me, that's commercial, and it's not a spreadsheet evaluation. It's just a commercial how things work in the reality of the market.
Okay, so
if we go back to the valuation of a company, 30, 40, maybe even 50 years ago, businesses were sold based on their asset value from their balance sheet, and they would start. So back in the 70s, there would start to be a little bit of oh, hang on a sec, the business sold for more than the value of the assets or even the depreciated assets. How do we account for this in accounting terms?
That's called goodwill.
And we'll have to call it goodwill, absolutely. And back then, goodwill was like 10% above the asset valuation of the business. If you have a look at it in today's terms, how many businesses sell for 10%, goodwill? The goodwill is more like 90% now.
It depends. It depends on the situation, basically.
But if we're looking for averages, and why is the goodwill value so high now? Well, the reason being is, and I think, the example is, I think it was Bethlehem Steel that the case study and the example where I took my learnings is all the plant and equipment was, worthless, but you have to know what to do with the plant and equipment and how to use it and how to market the product that you're producing with the plant and equipment, which is where the real value is. If I liquidate my business, I'll be lucky to get scrap value for my plant and equipment. Well, no one's going to sell a going concern for that. So if you have a look, and I know we can always find exceptions to the rule, but on the whole, businesses sell for a whole lot more than 10%. No business valuation. I'm sure we'll find some. But on the whole, valuations aren't based on asset value. It's a multiple of the profits, which is how most businesses are valued today. Profit times or an EBITDA times a multiple. That's got nothing to do with assets. It's how you use the assets. It's how you're leveraging the assets that determines the valuation of the business. And in my experience.
Okay, I appreciate
the conversation though.
Yeah, definitely. I am very much flowing with you, but it seems like you probably think I'm countering your argument, but I am just bringing like different lenses, in order
it's an exploration.
shed light on this, right? So the accounting perspective, right, is about the recognition of the value. Basically, accounting basically is about recognition, measurement, presentation, and disclosure. Those are the guidance that accounting standards give you. So, in terms of the real substance over form of these transactions, you would have to look at it from an economical perspective and also a commercial perspective, like yourself. So, fortunately for me, I am both an economist and an accountant, right? So, in terms of that recognition of that value, you're talking about the goodwill. So it's that invisible, that intangible asset, right? Which
Yep.
is you don't like the concept, but unfortunately it is actually a premium, right? Because if you were to strip those assets apart, right, and sell them individually, you would sell them for that less amount, right? You agree?
You'd sell
But
the asset, sure, and that's
yeah,
a
but because they're
liquidation.
bundled, right, within that business, we're able to sell it for higher than
Well,
what their market price is. Is that
only
correct?
because we've got a whole lot of employees who know what to do with the assets, and that's
Hmm.
what we're selling. We're not selling all of the plant and equipment together because that's how accountants treat it. They're going, hey, how do we bundle this? Well, we're just looking at the physical assets. The accounting industry hasn't caught up and figured out how to value, well, the intangible assets. So the accounting standards don't account for that.
There is a whole accounting standard on intangible assets. I think that's IS 38.
But you can't account for brand until you've paid for a brand. Right? If you bought a
Yeah.
brand, if you bought a business and you go, hey, look, we paid this much for the brand, well, then you can put it on your balance sheet.
Yes,
But if
exactly.
you've got a business yourself and you've built up and you've created a brand value
Hmm.
and you can demonstrate that all your customers are coming to you because of your brand, you can't account for that on your
But do you know
balance sheet.
why? Do you know why? Do you know why
Do I
that
know
is in
why?
accounting, right? So there is a concept in accounting called the prudence concept, or also known as conservate. Is it conservatism? Yeah. Basically, it's about you taking caution in terms of the valuation of your assets and your liabilities, right? So from an accounting perspective, it is actually favorable for you to undervalue the assets than overvalue them, because there is a risk of misrepresentation when you overvalue your assets, right? And when you overstate revenue, right? So they would rather, would I say, err on the side of caution, right?
Yeah.
So
And
if you allow people to start going about, valuing the brands, do you know what kind of, astronomical figures will be flying around in the air
oh, for
on
sure.
financial statements?
And it's worth noting that the businesses that we work with are privately held businesses. They're not corporate, they're not listed, they're not, large
Hmm.
corporate organizations that have a whole lot of shareholders that they need to report to. I'm talking about privately held businesses that, that are, all the shareholders are known to each other
Hmm.
generally,
Hmm.
and they're working together, and they don't have public reporting and accounting and auditing that they need and standards that they need to adhere to. So I appreciate that there's differences there,
Hmm.
and there's an element of governance and diligence that is required
Hmm.
for fairness
Hmm.
and for people to make informed
Well-informed
decisions.
decisions.
Yeah. But from a commercial perspective, running the business, most business owners almost couldn't care less, as long as they're making a profit and their business is growing and they're acquiring more clients. A lot of them just leave it to their accountant to go, well, look, we need to get we need to buy this new plant. Can we afford it? How do we pay for it? If you write it off and the asset value of it, we couldn't care less because we're just using it, and just let us know when we need to replace it. We'll
Hmm.
let you know when we need to replace it
Hmm.
because it's no longer productive or we found a new one that's so much more efficient. And the value of the plant, they're not even looking at, right? Because they're just running their business, building their business from a commercial perspective. They are They want to know that they're compliant, they're legally compliant, and they're paying all the right taxes, and they're, as I say, they're legally compliant. But at the end of the day, these are not the things they're focusing on from a day-to-day basis, because they've got an accountant who looks after that and ensures that they're compliant and paying the right taxes.
Okay, so basically, I understand that you are worried about a traditional financial accounting not taking into account the value of our brands and the value of internally generated intangible assets, right? So that is not permitted in traditional financial reporting. And of course, that is why we have management accounting, right?
Yeah,
And
absolutely.
in terms of the management accounting reports are used for internal internal consumption for internal decision making. So you could bring a valuation expert, and to value the brand, to value the intangible assets, internally generated intangible assets of, an entity, and put that in the management report, and nobody is going to arrest you for that, right? So for
Yep.
entities that are forward looking, that are proactive, and are commercially driven, they are allowed to do that, right? And that is separate from the financial statements, which is the traditional financial reports that are governed by the rules
Yeah.
of the financial reporting standards.
So yeah, look, I think yeah. So and I want to make sure that I'm not dismissing financial reports. I think every business should have a financial controller and a CFO at the right stage, and we're big fans of getting them in and using the financials to help business owners make better informed decisions and know what's affordable. And CFOs can do some really clever stuff and teach
Interestingly, the, the,
business
the guy on
owners.
the last episode was actually a fractional CFO.
Right. And we work with a lot of fractional CFOs. And I know that, and I've worked a lot with the CFO Center, and they've taught me a hell of a lot around the clever stuff that CFOs can do in leveraging the money and getting the debt equity ratios right, and the right level of funding, and what's available. Because without what many business owners tend to want to do by default is they go, well, we haven't got any debt, so we're doing much better. Whereas, and you get a CFO in and they'll go, well, no, let's get some debt in place because we can really leverage the business up and accelerate the growth. And it's a good thing to do. Whereas the default mindset is debt is bad.
Uh-huh.
So don't get me wrong. I'm not against good financial reporting and financial controls.
Uh-huh.
I'm just saying my suggestion is that valuing a business based on assets is not a real reflection of the market valuation of what a business is. And the goodwill factor is almost meaningless, or it's not meaningless, but it's not helpful, I don't think, compared to a market-based valuation. And then, to throw more confusion in, you get strategic buyers who'll come in and they'll go, well, I value the business a whole lot higher because I can buy that business as a going concern, plug it into our operations. And if I plug this business into our operations, I'm up and running so much quicker than it would take me to build a business of that scale and size, because it'd take me years to get up there. So there's an opportunity cost. If I plug it into my business and then use their operations and put my product through their operations, I'm going to make so much more money. From a value perspective, they'll go, that's worth more to me. So they'll pay more than perhaps a trade buyer would or a financial buyer would for that business. And so that's why we're saying before, value is in the eyes. It's the buyer who determines the value of any sale, I believe. That's from what I see in the marketplace.
Okay.
We got a
I
little bit
think,
off track, haven't we?
yeah, but then I think I would partially disagree with you on the part where you say the buyer is the determinant, right? Because I believe that is partially correct. And I would actually, try to expatiate on that. Interestingly, I am going to be at UFC London tomorrow, and the UFC is a brand that is very, very dear to my heart. Dana White and the Fertitta brothers, they bought the UFC in 2001, and it was just the UFC logo and an old ragged and rotted octagon. They bought the UFC for $2 million. And there was a company that had the
What was
rights.
the asset value? What'd you say? They bought it for 2 million.
Yes, they bought it for 2
What
million.
was the asset value of, on the balance sheet at the time of that transaction? What was the asset value?
It was pretty much nil, pretty much rubbish, because basically they just had some fighter contracts and an octagon that was not even in proper shape. But they saw the value, right? The
Exactly.
potential, right? Potential over credential is what they saw,
So the buyer determined that it was worth 2 mil.
right?
Wasn't the
So,
marketplace. It was the buyer who said, if we pay 2 mil for this, we can turn it into this. And that's our opportunity. Because they had no assets, they had a brand, they had a reputation, they had a contact list, and they had a bit of a history. And they've gone, yeah, the history's not going the way we want. We reckon we can leverage it, and through our contacts and our networks, we get an amazing return.
at the time, it was called human cockfighting. And of course, you saw the likes of Senator John McCain strongly advocating against, the UFC in America. They were finding it difficult to get sanctioned, across different states in America. But they had to put in that work to get it to where it is today. And
It's not a world I know, but I'm just sort of trying to apply some commercial logic as to yeah. So I
and
think
you
it
know
always works.
something, in 2016, they were able to sell that brand to, I think it's a Zuffer. So they sold it to Zuffer for $4 billion.
And what was the balance sheet value then?
I'm not close to the details. We could
Yeah.
find out, but I'm not close to the details.
But the balance sheet value is probably all cash in the bank, or the balance. I don't know
No,
what would Biden
definitely.
have
As of
on the balance sheet.
2016, definitely they had, like lots of land and property. They had the UFC Apex in Las Vegas. They have the UFC PI. So definitely they already had like solid tangible assets, right?
So
But
they bought properties,
definitely, yes, definitely they had property to their name, right?
but the properties, it wouldn't have been. What'd you say it sold for? 2 billion.
I don't think it's up to 2 billion, right? And that is
There's a whole lot
the
of goodwill
intangible.
there, isn't there?
That's the intangible asset, right? Because you see how big the UFC brand is right now, right?
Yes, huge brand value
A very,
now.
very, very huge brand value, right? But you see the thing with traditional accounting erring
Yeah,
on the side of caution, right?
that's what you need them to do.
Yeah, it doesn't mean that it is irrelevant, right? Because it is just an aspect, of reporting. And remember what I told you about traditional financial reporting. It is about four things: recognition, measurement, presentation, and disclosure. Those four
Yeah, and
things, right?
and maybe you misunderstood. I didn't mean to say traditional accountants were irrelevant,
Okay.
and I hope that didn't come
Now,
across.
now we're
I think,
converting.
yeah, I think some of the report, and as I say, I'm a big fan. Look, everyone needs to get their financials in order. They need to know what they can afford, because most businesses, if they don't get their cash flow right,
Mhm.
they'll grow and cripple themselves with growth, because they'll grow too fast. They can grow too fast. So yeah, I'm a big fan of getting the numbers right. I just don't think the traditional, the old style ways of valuing a business is very helpful in a modern marketplace. I don't think an asset based valuation model is the right model in most situations. I'm sure we can find a way to go, look, an asset based valuation is the right way to value a business. I think it's more the exception than the rule today.
I agree with you on that. An asset-based valuation is, let me say, a net asset-based valuation, right, is not always the correct way to value a business. That is absolutely correct, right? Because the business is beyond just the physical assets, right? And that is why there is a whole accounting standard, IS 38, that addresses intangible assets, right? However,
Mhm.
the constraint, when it comes to the financial reporting side is the fact that it does not allow you to value those assets until a buyer has put a value to that asset, right? And let's now come to the aspect where we talk about the buyer determining the value, right? And of course, I think that is partially correct, right? Why is that partially correct? Because the market forces of demand and supply is what actually determines the value. You are probably adopting a simplistic model wherein you have just one buyer, right? But it's not in all cases wherein there's just one buyer. Sometimes, a brand is so attractive that it has multiple buyers. And of course, you would probably have bids. And in the process of bidding, the brand, the business would actually go to the highest bidder. And of course, that's where your economics comes in, right? Of course, you have macroeconomics, you have microeconomics. And of course, there are economic factors, right, that determine the price of a business. So, for example, the price of a business pre-COVID is probably higher, of most businesses actually, was actually higher than what it was as at the COVID era. And the brand of certain, would I say, tech companies, right, pre-COVID, right, grew astronomically after COVID. So basically, the market forces of demand and supply is what truly determines the price
Are you
of
referring to
business.
stock prices?
And not stock prices. I'm talking about the valuation, right? Valuation actually changes over time. So
I hope
sometimes you
so.
have an increase in valuation, right, at a point in time, and due to certain circumstances, right, you could have also a fall in that valuation. You have gains and
Yeah,
losses in valuation.
but that's only visible for a listed business. It's not visible in a private business unless they are
Why do you
getting a
think
valuation
that
every
is not
year.
visible?
Well, unless they're getting a valuation every year from a consistent source, because their accounts aren't published and they don't have a liquid marketplace for buying and selling of the business through shares. Most private businesses, the market for their shares is closed.
Yes, that is very true. But the fact that a valuation is not done does not mean that a valuation does not exist. Do you agree?
No, that's what I just said. It's not visible
Hmm.
unless they're getting a valuation through the same source, the same consistent source of valuation year on year,
Exactly.
which I've never seen happen. It's very
It's
rare that they get a
very
regular
rarely
valuation.
happens with private businesses, right?
Yeah, that's what. Yeah, and I'm just wondering if we're getting confused by comparing listed businesses where they have full transparency and they have to comply with a whole lot more accounting regulations so that we can equalize things and compare them similarly
Hmm.
to small businesses that are privately owned, or I should just say privately owned businesses, where they don't have those obligations or requirements placed on them. They've got some requirements that they need to comply with, obviously, but their valuation is just not readily visible.
Okay.
And unless they're selling shares, and an exception that I'm familiar with, which that I'm seeing is if there's a market, an internal market within the business
Hmm.
where employees are buying shares through an employee share ownership plan,
Hmm.
which is becoming more popular and big advocate of that, by the way. But again, every year we'd look at the financials, we might compare a valuation then, and you'd have a look at what the valuation is, and hopefully the valuation's grown, and then all the employees can see, well, the shares we bought last year have increased in valuation. I'm keen to go again, buy some more. And then the founders are gradually selling down through this mechanism, this internally created market that they've stimulated, which wouldn't normally exist otherwise.
Okay. So I think in some way we've actually reached a landing, right? So I sort of agree with you, right, that the buyer does determine the price, right? But does not independently determine the price, right? Because the price that a buyer would actually throw at a business or for a business is actually informed by certain factors, right? And what actually
Sure.
informs that buyer to put or to peg a particular price on that business.
Look, I might be being pedantic here, and it could be a language piece. So the price is like we go back to the pair of jeans example. The price, the seller determines the price,
Hmm.
whether it's $10 for the jeans at Walmart, Asda, or if it's $200 for a pair of jeans with a designer label. The seller said, I'm going to sell them for $200.
Mm-hmm.
The buyer can then come along and say, I think it's worth $200, I'll buy it. Or they'll go, I'm not paying $200 for a pair of jeans. That's ridiculous. I don't see value in that. They won't buy it. So that's what I mean when I say, look, the seller sets the price and determines the price.
Mm-hmm.
The buyer determines if they think that price is valuable. When it comes to selling a business, it's a bit more of a negotiation, as you were alluding to earlier.
Mm-hmm.
And it's a one-off business. You've only got one business that looks like this. We've got to come to agreement. Well, I'm happy to sell it for this price, and you've got to make an offer. And I'll go, yeah, and we'll do a bit of horse trading in between. And I really like your point of, we really want to get the business to a point where it's attractive to more than one buyer. Because if you've got more than one buyer or more than one person
So
interested,
you have that invisible hand in action.
yeah, you get some competitive tension, which it's more likely they will spend or they'll pay their true valuation, because they'll look at they'll do due diligence on your business, and they'll look at they'll pick it all over. They'll really want to understand your business, and they'll only be able to learn about your business by pulling your financials apart. So you absolutely need good financial record keeping to the standards. And they'll want to have a look at your accounts, and they'll go, well, based on this and the opportunity that we see of buying this business, it's worth this much to us. It's a bit like an auction, I guess. They'll go, we're prepared to pay this much for the business, 10, 20, 50 mil, whatever it is. We're prepared to pay this much. We're not prepared to pay any more. And if the seller says, I'm not going to sell it for that much, then they won't achieve a deal. If the seller says, yeah, you're going to give me that much, yeah, that's with what I think it's worth. I want to sell it for that much. And then there's a chance that they'll agree a deal, and the seller thinks it's good value and the buyer thinks it's good value. And when you achieve that harmony, you'll get a deal and everyone will walk away happy. But there's a lot more tension and toing and froing when you're selling a business compared to a nice simple example of a pair of jeans.
Mm-hmm. But that
I'm just trying to
negotiation,
explain where we're helping, where I guess our perspectives are slightly different, which is
we are
all good
actually
fun.
converging right now. And of course, I love what you just said, right? Because you are just alluding and corroborating with the market forces of demand and supply, right?
Yep.
The seller sets a price, the buyer sees it and says whether he agrees with that or not, right? Market forces of demand and supply. Simple
Yep.
in action, right? Even in a situation where you have just one buyer, right? It's still the market forces of demand and supply. Because
And they're
if it's just
definitely
one
influenced,
buyer, it means that it's not attractive enough to the other buyers.
for sure. Yeah.
Still market forces of demand and supply.
Okay.
You see, we reached a landing. I'm happy we have finally reached a landing. You get it? It's economics, in commerce playing out. Basically, it's the invisible hand. If a business is attractive enough, right, there will be multiple buyers bidding. And of course, that final value that they would even arrive at is still worth that equilibrium price, which is decided by the market forces of demand and supply. So let's talk about, de-risking. You often talk about de-risking the deal. So
Yep.
what are the biggest risks, buyers see in founder-led businesses?
Well, I think we've touched on them, but to recap, so the risks are, what are the likelihood of the revenue pattern? So a buyer will look at the revenue pattern from the last few years and go, what's the likelihood of that revenue pattern continuing under new ownership? So the biggest risks is, how much involvement do the current owners have in that revenue generation pattern or that profit generation pattern? So there's the biggest risks. And then the things that influence that outcome, that pattern, the management team. How robust and how strong is the management team, and what's the likelihood of that management team staying in place after a change of ownership? How is your revenue constructed? Is it one-off purchases? Is it subscriptions? Is it contracts? What's the nature of your revenue? Your staff turnover, how skilled and how loyal are your staff? How long do they stay? And what's the culture of the organization? Are they all motivated and aligned and incentivized for the same outcomes? Have you got any IP? Are you known for anything in the marketplace? Are people being attracted to your business because of your people, specific people in the business, or are they attracted to the brand or the IP, the intellectual property that you've got in your business? So there's a quick, rundown of some of the key influences to how that valuation will stick and attract people to want to keep talking and perhaps find a deal.
Hmm. So, talking about the earnouts, right? So, why do so many
Yeah.
business owners end up regretting them? And of course, like, how can they avoid being stuck post exit?
Okay, so I guess we need to clarify the difference between an earnout and a deferred payment. So a deferred payment is locked in and it just will get paid over time, assuming everyone's credible, but they're not contractually at risk. An earnout is when we go, hey, look, you want to sell your business for this number. I think it's worth a lesser number. But if you stay and help achieve these goals over the next couple of years, the next 2 or 3 years is a common period, then we will pay you these sort of bonus payments that will get you up closer to the number you think. Now, the problem is that most business owners have, and the struggles where these occur is they fall into two camps, really. The first camp is that the owner is no longer the owner. They're now an employee working for someone else, and they don't agree with the direction or the way that the new leadership team, the new ownership, are handling and running the business. And they can no longer call the shots. They're used to being in control and running the business themselves. They can no longer call the shots on how decisions are made in the business. And they get frustrated with that and they'll walk away and leave money on the table. That's one way they get frustrated. The other area that can be risky for business owners who agree to an earnout is they don't get clarity around what the earnout terms are. They're just vague, open promises. And the problem with that is there's no clarity, and the new owners can move the goalposts. They can change the way they're running the business, which is totally within their right, which then ends up making it impossible or very difficult for the old owners, the founders, to achieve the targets that they had to try and achieve to achieve the earnout payments. And so that's the second area, that the rules of the game have changed effectively. And so, again, if we're an earnout, all the risk is on the founders of the business, and they very rarely are successful.
So, you have been an expert in helping businesses, the founders with the exit process, but there has to be a mindset shift where you are switching from running a business to preparing it for sale. So, what are the mindset shifts that these entrepreneurs have to take on?
So the first one is the one that we've touched on already, where they need to make that shift from, and this is the big one, from thinking about profit growth to valuation growth. And the only way that happens is if they are getting regular valuations from a third party, an independent valuation specialist who does valuations all the time, and they're using a consistent approach. So they're doing
Reliable
it from
experts.
so they're doing it from a valuation perspective rather than a taxation perspective, for example, and to trying to create that market valuation through a buyer's lens. Now, if they're doing that regularly, then they can see the valuation growth each year, and then they'll start looking at all of the things that the business owners need to do to be working on their business rather than working in the business. And it's all the things we've already discussed. It's going, how do I build a brand? How do I build some intellectual property and process methodology that people will be attracted to that rather than coming to the people in the business because Tom, Dick, or Harry work in my business? How do I build the culture of the organization so that I get people performing at a higher level and being more loyal and staying longer? What are the things I need to do to improve my marketing so that I get a better flow of clients who are ready to do business with me because they know what's special about my business and they want to do a business with me rather than just shopping around and comparing prices. So all of the things that improve brand and improve cash flow reliability and retention are all the sort of things we're looking at, and eliminating owner dependence.
So basically, what separates those owners who walk away satisfied from the deal and those owners who end up being disappointed?
I think the ones who walk away satisfied have prepared their business, they've done some preparation, they have a realistic perspective of how their business will be valued from an external perspective rather than from their perspective. And they know they've done some education and they've learned what's required to go through an exit transition. So they know what's coming, they know how long it's going to take, and they know they've prepared the business to minimize their earnout and ongoing obligations. So, they're more likely to have their expectations met. They'll be happy. Those that are unhappy are the ones who have done no preparation. They just get to a point one day and they go, right, I want to sell my business. They'll find a broker, a corporate finance, M&A specialist, and they'll just put their business on the market. They've done no preparation. So everything that happens is a bit of a surprise. And, they'll go through the process. It'll be quite a painful process because they haven't done any work in preparing it. And they are unlikely to, because their expectations are unreasonable, they'll be unlikely to achieve a deal that they expect to happen. So they'll end up feeling disappointed.
But there's something a lot of business owners who want to make an exit like to say, and that is exiting on your own terms. So in your own words or your own definition or your own experience, what does it truly mean to exit on your own terms?
To exit on your terms is that former that we just discussed. It's when you've done the preparation so you know what's coming. So you set the time frame. You've prepared your business is exit ready. You're ready for exit. You know what you're going to move on to. You've got a plan. You've got a vision for what you're going to do next in your next chapter. You're not just going to be sitting on the beach drinking pina coladas because you'll get bored with that after a couple of weeks. You know what's happening after that. And you've got a realistic valuation of the numbers. So the numbers are going to work for you because you've done some personal financial planning. You've probably spoken to a wealth manager and you know how much investments you need to live the lifestyle you want after you exit the business. You've transferred the assets. You've got a plan in place. It's on your terms. If you do no preparation, that's when you're selling your business to someone who's likely bought businesses before. You've unlikely sold a business before. And so therefore, if you're selling it to someone who's bought many, they know the tricks of the trade. And if you're not prepared, you'll get pushed around somewhat. If you haven't done your homework, you get pushed around, you get bullied, and you're going to be doing it on their terms more so than your terms. They're
So,
calling the shots.
so from your own experience, are you able to share like a real life case where a founder was able to transform their business from an unsellable brand to something that is highly desirable and they had a good exit?
Yeah, so there's one in particular that I can think of, and obviously I can't give you any names.
No names required, please. Anonymity.
And they were pretty much, I'll say they were a service business. They worked with people and placing expertise, but they had no brand recognition. That the owners were living from hand to mouth and taking money out of the business, and then as much as they could, as regular as they could. So they didn't have any control of the finances. So one of the first things we did is we said, right, we need to get the business to the point where we've got control of the cash flow. So you've got a visible runway of what's happening with the cash flow. So we brought that under control. We got them caught up with their tax payments because they were getting behind with those because they were spending the cash flow and they were just spending the money by gut feel. So they now had a runway of the cash flow based on the contracts and the work they were getting. We got in a dedicated MD type of person who facilitated. So he and the fractional finance person were running the business from a controlled perspective and producing regular reports, both financial and operational reports, to the shareholders who were involved on the board. And we really got the business operating functionally and from a control perspective. So it was no longer being run from memory and from gut feel. Everything was through reports and plans and informed perspective. That enabled them to create budgets and keep the MD accountable to the budgets and set plans because he knew he had the cash flow available on what he could do and how he could run the business. And that business, I think we got it was a fairly small business to start with, but over 3 years, they tripled in size from a revenue perspective and their valuation went up 4 times.
That is a
By getting a whole lot of
tremendous.
controls in place.
That is really tremendous. But, have you ever seen a business that is deemed too late in its life cycle to salvage for a good exit?
Oh yeah, all the time. We get approached by business owners who go, "Hey, I want help to prepare my business for exit." And we go, "Great. What's your timeline? What's your runway look like?" "Oh, we want to sell it this year." And you go, "Good luck," because to get exit ready, yeah, look, we can work with an accountant and tidy up your financials, or a CFO. You can get your financials tidied up and they can make some adjustments, but and that'll tweak your profitability. You're not going to get any opportunity to tweak the multiplier that will be applied to your valuation, because the multiple on your profitability is a factor. It's a measure or assessment of risk. And your business, if you're involved in the business, it's too dependent on you. Everything's in your head. You're doing it from memory. When you go, all that history disappears with it. So, the new owner doesn't have a handbook, so to speak, to go, here's how I run the business. So if you buy a new iPhone, you get an owner's manual with it and a quick start guide. So, for new users, you know what you need to do quickly to get up and running. And if you want to learn the advanced features, you've got a complete owner's manual there. Too many business owners are actually trying to exit their business without providing a quick start guide or an owner's manual. And that's detrimental to the valuation of their business. They'll end up leaving because they haven't captured the value because it's just too risky for a new owner.
Speaking of a quick start guide, I would like for you to provide some advice to young business owners and, of course, early stage founders before you leave. So, for those kind of individuals that are listening or watching us today, what are 3 things they can start doing today to ensure their business becomes a valuable asset tomorrow?
Create a structure, a functional structure for your business that captures everything that needs to happen. And that's going to be the same functions for many businesses. You're going to have accounting and finance. You're going to have HR. You're going to have systems. You're going to have all of your operations. You want your sales, your marketing, your onboarding of new clients, your how do you deliver clients? How do you keep them happy? What's your marketing look like? What's your recruitment look like? What's your training look like? And then what's your business planning look like? What's your vision, your culture, and your product strategy? If you start to structure all of those things on a chart and identify what needs to happen, you might not have a number of people to fill those boxes yet, but all the boxes won't change as your business grows. As your business grows, you'll just spend more time in each box, and therefore you'll need more people in each box. So let's call that a functional structure for your business. There's step 1 towards documenting your business. Then you want to document your workflow practices. How does work flow? What's your standard operational workflow? Your primary workflow is what I call it, from marketing all the way through to client fulfillment, delivery, whatever you call it in your business. Document that workflow as your primary workflow, as your first point, to ensure consistency and reduce rework, and so that everyone knows how to do the job. And so what's the third thing? I would say, depending on the size of your business, get a fractional CFO. They'll make a huge difference into your business.
And now you're making me happy, and of course, you're making the last guest on the show happy because he is a really, really solid fractional CFO. But how about those founders who are probably considering selling within the next 12 months to 2 years? So, what should they be doing now?
So, if they haven't done those things we just talked about, get them done, because it's, the sooner you get that done, and then document everything that happens in your business. So there's that.
Okay.
Make sure
Okay, you wanted to give them additional advice.
Okay, yeah, I'm getting there. Then the next thing you want to do is document your marketing machine. What are your various routes to market?
Mm.
How do you leverage that? So let's call that a talent machine and sorry, a marketing machine. So we'll get all of our various channels because we don't want our clients coming from just one source. We want to demonstrate that we've got three or four sources, three or four routes to market where our clients come from, that we're able to target. We know who our ideal clients are. We know where to find them and how to find them, and we know how to message them that engages with them and that they want to be interested in having continuing conversations with us and learn about how we can solve their problems. So there's the marketing machine. The next one is we need to balance up, going back to earlier part of our conversation, but within our own business, supply and demand within our own business. So the whole idea of the marketing machine is to create demand out in the marketplace for our solution, our product, to whatever it is, the problem we're solving. We want to create demand for that. Now, if we keep creating demand and we don't have enough capacity to fulfill it, we're in trouble. So we need to build a talent machine, which is identifying new talent that can help us, recruit that talent, get them on board in our organization, train them in our ways of doing things, and make sure we've got enough capacity to meet the demand that we're creating. And if we can get that imbalance in harmony, we've really hit the jackpot because we've mastered that. So the talent machine and the marketing machine. So they've got those two systems happening now. And the next one, the third one that I would be looking at is if I've got a management team in place, I would set up what I call an agile management system. But it's similar to, it's the agile management system is where my leadership team go, hey, we understand the vision that the owners have set. The owners want the business to look like this and head in this direction. Let's take that vision and the strategy that they've set, and the strategy being the product, the market, the position in the market, the pricing and packaging approach and the position, and how do we reach them. Let's take those strategic elements and go, right, what can we achieve this year to drive us in the direction of that vision using that strategy? And we'll put our goals in place. So we will systemize our leadership approach to achieving those goals, so budgets and goals and business plans, and then have a systemized approach that keep the management team accountable. And we've got the right sort of reporting and feedback mechanisms in place to keep us on track to achieving those goals. Because if we don't do that, it tends to just be, well, we'll set a budget this year and we just run the business for a year. And then we look back and go, oh, look, how about that? We hit it or we didn't. How about that? It becomes haphazard. So I really want to, the third thing is let's get the agile management system in place that keeps the leadership team accountable for driving business towards the vision.
I think that is actually a very, very robust recommendation, and I very, very much appreciate that. So it is always hard to say goodbye, but I would find a reason to keep you for a little bit longer. I'm going to play a quick game with you. It's called the rapid fire section, and I'll
Okay.
ask you a few questions, and you just give very brief, quick fire answers. Are you ready to rumble?
Well, hopefully it won't be a knockout.
Okay, yeah, well, come on, it can be a knockout, especially with a man whose name ends with a third. You are up to it. So,
Let's go.
number one, what role does intellectual property play in boosting business value?
What role does it play in business valuation? Significant.
Boosting a business.
Yeah, it's a significant role. Whether it be, I reckon there's two types of IP. You might like this, you might think I'm an idiot. But the first type of IP is KFC. I call it KFC IP.
Wow,
So it's like that.
I did eat KFC yesterday, so I guess that's the reason why you call it it.
Right. So KFC has a secret recipe, right? No one knows the exact recipe, but they are known for their recipe for how they do chicken, and it's that Southern style fried
And
chicken.
Coca-Cola
And
as
it's
well, you know.
Yeah, and it's fantastic, right? So that's one type of IP. It's a secret formula, it's protected, it's locked away, and only a few people have access to it. The other type of IP I call Subway IP, as in the Subway sandwich. So a Subway sandwich, it's just a salad sandwich, right? There's nothing special about it except for the way they put it together. And what you're buying there is the process, because when you get a Subway sandwich, you know exactly what you're getting. You design it. The experience is exactly the same in every restaurant you go to, and it eliminates the risk of going to a local deli that you've never been to before, and you're never sure what you're going to get. So if you go to a new place and you go, I'm hungry, I need some lunch, I need what do I do? Well, there's a Subway there, I know what I'm going to get. Or there's a deli there, it looks independent, I'm not sure what it's going to get. And there's not much of a queue there, so I'm a bit cautious. So it doesn't matter what type of IP you've got, as long as the marketplace knows about your IP and they know the value of that IP to them, then it's a significant part in the valuation.
Interesting. So how much does leadership succession matter in exit planning?
Again, significant, because if you've got the leadership team in place and people know how to come through the business, and you can demonstrate that you've got the next leaders in place and that the current leadership team are actually driving and running the business and the owners have a steering role only, then your business is going to be worth so much more than if you're involved and you're a key person in the business and the business relies on you every day.
Interesting. So next one, is it possible to sell a business without stepping away immediately?
Sure. You can. Now, the dream scenario that I think is that you sell the equity in the business and then you do a separate role where, or you might not sell all the equity because you could sell it to a PE and do a nice deal that way, but you can sell some of the equity in the business and you go, right, okay, that deal is secured. We've sold that amount of equity. I got this money for the equity. There's nothing contingent on that. I've got my money. Now, you've put some money in the business as well. Okay, now I'm an employee in the business, but we're now in partnership. Let's keep going, and I'll operate as an employee, and that's how PE often works. Or you could just act, even if it's just a small private deal, you could act as a consultant to the business where you go, hey, look, I'm on the tools now. The leadership team are running, but I've sold my equity, but I'm happy to keep playing and participating for a while. Let's do a separate deal, an employment deal now on how that's going to work. It's definitely possible to sell the business and stay in the business and do it successfully.
Interesting. So when should business owners ideally start preparing for exit?
The day they start.
I love that answer. I love that answer. So I think my final question to you would be, it's not business related, don't worry. If you were to go on a date with a business leader, dead or alive, who would it be and why?
I've learned a hell of a lot from Warren Buffett. I like the way he approaches and understands business and does his research. He's very methodical. So there's that. Michael Gerber would be fun as well. I reckon I'd learn a lot from Michael Gerber. So there's a couple of options.
Okay, interesting. So I guess I have no reason to keep you any longer. They say it's hard to say goodbye, but I think we've had a really, really insightful conversation today. We've had a lot of in-depth and thought-provoking conversations. It's full of insights, hindsight, and of course, foresight. They say the SI unit of measuring life is time. And of course, if somebody shares their time with you, they have shared their life with you. And of course, for me, I always love to say that gratitude is good attitude. And from me to you, it's love and respect to you. Thank you very, very much for sharing your time and your life with me. And of course, my wonderful audience today. I very, very much appreciate you. And before you leave, do you want to leave us with where the audience can catch up with you, ask you questions, patronize you? And do you want to leave a shout out for anybody?
The best way to find me, and I've really enjoyed the conversation, Adamola.
Wow.
So the best way to
Thank
find
you.
me is my name's on the screen. There's only one of me on the planet with that name. So
Don't worry, it's going to be in the description. It's going to be in the description on YouTube. And that is
So the
Darryl.
best way to find me is on LinkedIn. That's where I spend my time in terms of social. But Succession.plus is the website. But find me on LinkedIn. That's the best way to get in touch.
Okay, fantastic. A shout out. Are you leaving a shout out for anybody?
Just the team that I work with at Succession Plus, they support us, and it's not just me, it's a whole team that bring everything that we do to help business owners prepare for exit, make sure the business is exit ready when the owners are ready to exit, and with the numbers that are going to work for them. So yeah, it's a team effort.
Teamwork makes the dream work. Wow.
For sure.
And of course, you guys, if you have come to the end of today's episode, what are you waiting for? Please go like, subscribe, share, show us love, support, join the channel. And of course, I will keep working tirelessly to bring in fantastic individuals like Darryl on the show to educate us, to inspire us. And of course, I would like to steal Darryl's time again so that we can have another debate very soon in the future. Thank you very much, guys. And of course, thank you very much, Darryl. I very, very much appreciate you. God bless you.
Cheers.
Whoa.